Consumer price index crossing right now and coming in more benign than estimated, 0.3%. The headline increase in September inflation on the consumer level month over month. Core coming in with an increase of just 0.2%. Both of those numbers 0.1% better than had been anticipated. The year over year figures on both core and headline both coming in at 3%. So again here, 0.3% the month over month gain in September in inflation. And recall, of course, that this is a delayed report. Remember, with the government shutdown, initially we were supposed to get this report not about 10 days ago. And so it was pushed back until now. And so this report really getting more weight as well, because we're not getting other data from the government. So again, this report coming in and showing inflation is not reaccelerating. In fact, it is decelerating right now. So the really not putting to rest, but at least pushing off some of the concerns about tariffs and the effect that they might have on inflation. So we continue to watch the markets. We are seeing an uptick in futures. Right now, the Dow futures indicating a gain of 1% at the open, the S&P futures 0.75%, and the Dow up about 0.5%. So at first blush here, these numbers looking pretty good. For more on the September Consumer Price Index report, let's bring in our roundtable of experts. Joining me now, John Hilsenrath, StoneX Senior Advisor and Yahoo Finance contributor, here with me on set, Joe Brusuelas, RSM Chief Economist, and George Bory, Allspring Global Investments Chief Investment Strategist for Fixed Income. Joe, I'm going to start with you. I had your estimates right in front of me going into this, and they were in line with the consensus estimate. So these numbers coming in better than anticipated.
Right. We're going to get that Fed cut everybody's expecting, I think, is the major takeaway from the first glance at the housing data, or excuse me, the inflation data. As in taking a look at it here, housing, shelter, and food all increased at a little bit slower pace than what we had penciled in. So it's looking a little bit better. That will help across the yield complex this morning. But we make no mistake about it. We're still seeing services advance at a 3.6% year over year basis, food at a 3% year over year basis. And even transportation, which was down, is just stuck at 1.7%. But it's looking better than what we initially expected. That's a market positive story this morning. And my sense is, though, as we go forward, remember, this is likely to be the last solid quality report we get until probably early next spring because of the government shutdown. So these BLS is going to be imputing or rather guessing at a lot of the estimates that they're making.
Wait, back up a second. You don't think we're going to get another government data point until spring?
No, we're going to get more data, but because of the government shutdown, it's going to create a lag in terms of quality data, which means is that they're not able to collect all the data they need, and they're going to have to impute, which means substitute in for data that they don't actually have. So this, in many respects, this is the last hard data that I'm going to trust probably until early next spring. But make no mistake about it, Julie, inflation's at 3%, and it's likely to accelerate higher. It's well above the Fed's 2% rate, and the Fed's got a lot of heavy lifting to do, and it's going to be probably a number of years, if ever, before we get back to 2%.
And John, I know that you have also been concerned about inflation. Does this report put any of those concerns to rest? It doesn't sound like they do for Joe.
It doesn't put them to rest, but listen, these are good numbers. And let's talk for a second about what it means for the Fed, because the Fed has been of the view that inflation is going to recede, and it has the leeway to proceed with cutting interest rates. And what this report means on the face of it is we're sure to get a rate cut next week, a quarter-point rate cut. And then the market's immediate response to this is going to be that there's likely to be another rate cut in December. So this is very bullish news. I personally think that there's going to be some inertia and persistence in these inflation numbers going forward. As Joe just mentioned, we're not going to have quality data. But let's take this report for what it is on the surface before we, start reading the entrails. This is better than consensus, and the Fed will feel comforted by this.
And George, we're seeing bond yields tick down already in responses. They were already sub 4%. They're going even lower. Do you think that this is the market saying, yeah, we're going to get 2 more cuts this year? And do you think it's premature to make that kind of conclusion?
Yeah, as the other guest had mentioned, obviously the number's better than expected, but still well above the Fed's target. So we can take some comfort in the notion that inflation is perhaps decelerating, but it is a little premature to signal the all clear. Bond market seems to like it. It looks like bond yields have ticked down a little bit. We're now sub 4% again. We'll probably be stuck here for a little while. The 10-year's been stuck in a range for quite some time, and we're likely to stay well within that range kind of going forward. But as expected, as mentioned, it does provide cover for the Fed to continue down this path of really like a mid-cycle adjustment to recalibrate Fed policy to be more in line with both the inflation data and the growth data, and it gives them room to cut next week. That's clear. The market has nearly 100% probability of a cut priced in. December looks likely. Beyond that, remains to be seen. As Joe mentioned, the data is going to be squirrely at best over the next couple of months, and inflation is still sticky, and it's kind of stuck. Actually, it's stuck around 3%. So the Fed has some work to do if it truly wants to get to the 2% target. They don't seem to be too concerned about that at this moment in time, but that may start to become problematic as we get into next year.
John, I want to bring you on that last point, because it does feel like that commentary from the Fed, what we've gotten, has really paid more attention to the labor risk than the inflation risk. And, these numbers seem to give them some cover to continue to do that, no?
I agree. So there's a couple of things here to talk about in that respect. The first is that the Fed has effectively said that it's prepared to let inflation run above the 2% target for another couple of years, in part because they think the effects of tariffs are going to distort the data and that they're going to have a transitory effect. So, the Fed's forecast for inflation next year and the year after remains above that 2% target. On the labor market side, this comes back to the question of not having quality data. So the Fed wants to bring the short-term rate down because they say they want to get it closer to neutral because the job market looks like it's softening. Well, are we going to know if it's still softening over the next few months without quality payroll data? The answer is not really. And this raises a question for me. And I think that Chris Waller was getting to this in a speech that he gave last week. But what should the Fed's response be in the absence of data? Should its response be to continue with the plan that they formulated when they had good data, or to hold back and see how things play out until they have a better feel? The market right now is convinced that the Fed is going to proceed with the plan in the absence of data. I think there's some people at the Fed who are saying, well, wait a second, maybe we should actually, it's kind of like driving in snow when you can't see out the windshield. How fast do you want to drive when you can't see what's coming at you?
Yeah, I like that analogy, John. And Joe, I find it interesting that ahead of the government shutdown, we had lots of conversations about alternative data, right? Oh, we're going to be looking at this report or that report. Now that the government's shut down and we're not getting those government reports, I'm hearing a lot less talk about those alternative data sources. Everybody's just kind of waiting for the government numbers, right?
Well, I'm not so certain about that. I think what happens is you got these private label data that only a certain subset of investors can afford, right? I mean, we have our own private label data. I'm not going to share that out because what we think is that gives us a competitive advantage in it. And I think that's what happens is people go quiet and they start making investments around that private label data. Hey, Julie, obviously the Fed's going to cut in October. This is going to give them cover to cut in December, right? I'm looking at some of the data here, especially year over year. This is where we tend to get into navel gazing in the financial industry. Meet and Veal, the price is up over 14% on a year ago basis. Natural gas is up 8%, electricity is up 5.1%, right? Now, electricity fell on the month, right? Traders will think, wow, maybe we got a potential pivot point, inflation's going to decelerate. And that's not what's happening here, guys. It's just not. So this is going to be what's going to be interesting here is the disconnect as equity markets float up, as yields fall on this, and Wall Street gets very happy that low rates, liquidity, and leverage, which are the holy trinity of new finance, lifts the tide that lifts our boats, right? But out there down market, they're going to be looking at this and they're going to be like, guys, you've lost your minds. Do you know what's happening down market to our cost of living? It's rising. So it's really important here that we don't lose sight of that, because that's the source of this K-shaped economy that we're all constantly having to forecast, which, by the way, is becoming much more difficult without official data. Even though some of us do have private label data we can use to do that.
I just bought a beef tenderloin yesterday, guys. I was in shock. Yeah. But I got the butcher to put it aside for me, so I couldn't then say, never mind. Anyway, that's my problem. But George, so how in the market, how are you positioning yourself given the idea that maybe we are not going to get 2 more cuts this year? I mean, what do you do from a fixed income perspective?
Yeah, I think in bond portfolios, I think there's a couple things to keep in mind. It's just sort of keep it simple. Play the yield advantage that you have in the market today. Bond yields are still relatively generous. They're well above inflation rates, even at 3%. That gives bond investors some comfort. The long end has kind of come down a bit, but the curve remains fairly steep. So we can play positioning along the curve. And as we mentioned before, stay tethered to that front end. The front end does look like it's coming down, and it's likely to come down between now and the end of the year. That's pretty good. On the real side of the economy, as we discussed, lower rates do help, and both easier policy as well as lower rates, kind of help keep the cycle moving forward. The third quarter earnings numbers have looked pretty robust, and so things like corporate credit or even high yield bonds have done really, really well with corporate profitability looking pretty robust. And despite the fact that we do have a K-shaped economy, as Joe mentioned, kind of the broad-based nature of profit growth is pretty good. So we can take the yield that's in the market, we can go down in quality and still be fairly comfortable that credit quality is holding up. We know that there's some cracks. We've seen that in some of the recent headlines of a few very notable defaults. Those defaults do seem to be kind of isolated into certain corners of the market, which gives us some comfort, although we do watch this very, very closely. But our message is income is your friend and diversify your duration. If you do those two things, you're going to generate some pretty healthy both income and total returns in your portfolio. We've seen that in 2025. We think that's still the game plan as we go into 2026. There's a lot to chew on in the bond market right now, and the backdrop's fairly favorable. So don't fight it and take what the market offers.
John, I want to end with you on the credit question, because I know it's something that you've been watching really closely. And, most people seem to be talking the same way that George is talking, that it sort of corners the market. It's idiosyncratic. That's the word David Solomon and a lot of other people I've talked to have used. What do you think we need to be on guard for there, if anything?
Well, I mean, I think financial conditions are very easy right now. And I think we're in a period in the cycle where excesses are building, and they're still building. We saw some cracks, for instance, in the auto sector with some recent bankruptcies. But with the Fed continuing to ease, with financial conditions getting easier, I think these markets are going to keep going, and we're going to see the risk continuing to build for a little while. Just to play on what George just said, income is your friend. In this environment, risk is your lover. And love affairs don't always end well. But in this case, I think the market is in love with risk, and we're going to see a lot more risk taking for the months ahead.
The U.S. stocks are rising as the September CPI report cements investors' bets on a Federal Reserve rate cut at its October meeting. Joining us now, Omar Aguilar, the Schwab Asset Management CEO and CIO. Omar, it's great to see you. So, seeing this report, Does this sort of put inflation concerns to rest?
Well, one data point doesn't make a trend, so it is clear that the stable picture of inflation is something that the Fed will probably take this report as a positive. I mean, it's something that they are expecting to use as part of their decision next week for rates, and that should actually put their focus on the labor market. They obviously have continued to see the trends. This is a very good indicator that at least inflation is under control, but still not close to their 2% target. So I think their big decision is not only, how much they go in monetary policy easing, but also how much longer do they do it? Do they do it just, twice this year, or they continue going into 2026?
Well, and they're doing it, and we're all sort of operating with whatever analogy you want to use, in the dark, with both hands tied behind our back. I don't know what you want to call it, not getting the data that we normally get, Omar. So as somebody who's in the market, how do you make your investing decisions? This was a one-off today. We're probably not going to get another one of these for a while.
That is indeed the case. Normally what we try to do is obviously deal with uncertainty, and we have to evaluate what are the different pieces that we have, putting all the different pieces together to try to estimate what we might be looking at the data and understanding that there's going to be a prediction error or anything that we do. Yes, we probably not going to see another data point for the rest of this year on CPI, on inflation, and we will have to look at extrapolating areas like, for example, what are the earnings reports telling us? The earnings that are coming into, the current season will tell us that, there's losers, there's winners, there's companies that are passing through those price increases to the consumers. There are other companies that are taking it because they had a good profit margin, and therefore they're trying to, keep their prices lower. So we're trying to just look at all the different pieces to estimate what will be the impact on inflation. We'll look at trends in housing and looking at trends in rents, trying to look at trends in commodity prices to try to extrapolate what would be the trends in inflation. And so far, our research suggests that inflation will probably stay stale for a little bit. Doesn't necessarily seem to be going, down or up enough. A lot of that is because the implications of tariffs have not really gone through inflation numbers. That, again, could be just because it's absorbing earnings, but certainly, something that we continue to watch.
I mean, it's showing up in some places, right? I just saw somebody pointing out on social media, audio equipment prices, for example, have gone up because they're subject to tariffs. Furnishings have gone up; they're subject to tariffs. So we're seeing it in little areas, and I shouldn't say little. I should say isolated areas. It also comes to the sort of jobs data that we're getting or not getting. And I can't help but noticing on an anecdotal basis, we have Target cutting jobs, we have Ford cutting jobs, Meta, Rivian, so a lot of jobs cuts coming from individual companies. And if we're trying to use individual companies as another proxy, what do we take away from that?
The job market is clearly in this soft patch. We have been all this year looking at this, I would say, very unique balance between supply and demand. On one hand, the supply of workers has actually been reduced because of just the demographics and aging population and immigration policies that have reduced the supply of workers. And on the other hand, we have seen probably a little bit of more cautious way to add new jobs for companies as a result of uncertainty of trade policy, also as a result of potential, deceleration of the economy and the AI productivity gains. So when you put that balance, that's where we've been in this market of the labor market being in this no hire, no fire situation. But I think that it started to change. As you pointed out, there are certain companies that, will prefer to keep their margins higher by not increasing prices, but at the same time reducing their costs and therefore, reducing their workforce. On the other hand, there's other companies that will probably, had a lot of capital expenditures early that they didn't deploy, and therefore this may be the time for them to start hiring, workers because they did have a lot of capex that was not, fully utilized as a result of the uncertainty on trade. So we're going to see how this goes. But what we, think in our research is that that the labor market is going to continue to soften, and it's really just how much the Fed helps in terms of stimulating the economy for that to recover.
And Omar, the other thing I wanted to get your take on is the sort of signs of froth in the market. As you know, there's been a lot of talk about whether there's been sort of over speculation here. What do you think?
Well, we have been discussing this with our clients, this year, but in particular the last 3 or 4 months, because, it's the story of the overly concentrated market in 7 stocks, has been going on now for a few years. And we have encouraged our clients to start diversifying, going into other parts of the market, because the headlines that we normally get in terms of valuation and in terms of just index performance, they're probably not representative of everything that is going on market-wise. So there's a lot of cross currents under those circumstances, a lot of rotation that is happening. The example that we provide is that, even though the indices have experienced some volatility over the last couple of weeks, underneath the surface, we had seen quite a bit of, momentum strategies going high and low very quickly. Just a week ago, certain parts of the market, underperformed significantly. And when you look at areas like small cap, there's significant amount of low quality, volatility going into those areas. So we do think that these are signs that the market is getting into a place where, investors are starting to just figure out that they need to start changing their strategy, not necessarily just going for the momentum trade. And the momentum trade is something that has worked, for a long time now, but it's also very risky to maintain that level of exposure to momentum.
Right. Momentum works until it doesn't, and then maybe it really doesn't, but we'll see. Omar, thank you so much. Good to see you.
This report, or the CPI report that we finally got, what's the read-through to the Fed next week? And the market seems to think we're getting a 25 basis point rate cut, but is that signed, sealed, and delivered?
I think with today's CPI report, it definitely is. That's the green light for the Fed if they needed further evidence for a rate cut. That's what the market is pricing in as well. Right now, the market, though, pricing in 5 cuts by the end of next year. The Fed just told us in September, look, 2 more this year, maybe 1 next year. So there is a gap between the market expectations and what the Fed's telling us. That gap tends to be a source of volatility. Of course, we'll see what the Fed has to say next week in terms of their outlook. Has it changed really since the September FOMC meeting?
Adam, look, if we're going to get all these rate cuts, is the reality just this? It is hard to not buy dips in the market.
Right now, I think we're at a fine line in terms of where rates are, where expectations are, because if we start pricing in more rate cuts and the Fed becomes incrementally more dovish, you have to ask yourself why. And it's not because economic growth is getting better. It's because they're seeing maybe more signs of a slowdown. How long can that last in terms of buying the dip? We think if we start to see those rate cuts get priced in and the Fed turn that, be really more dovish, I think recession fears are going to percolate pretty quick. Now, that's not our base case, but we do see that as a risk, especially when you look at the trends in the fixed income market. We have the long bond moving lower, 10-year yields moving lower, below 4%. To us, that's a sign maybe the fixed income market is pricing in a little bit of a slower growth outlook than maybe the equity market is looking at.
Brooke, not everything in the CPI report was roses. I get the headline, I get the market response, but you dig into it, a power price is starting to pick up, likely because of tariffs. You even had some food areas also pick up. The meat and poultry index and eggs that were up, I believe, 5% or close to that. I got Julie Hyman complaining about the price of beef tenderloin in her show. There's a lot going on. I mean, it's not exactly deflationary out there.
Yeah, there are some pockets where we are still seeing inflationary pressure, especially around that beef and veal category. It's up more than nearly 15% year over year. And that's really led by uncooked beef roast. That specifically was up about 18%. And that's really based upon this demand, this lack of inventory of these cattle, and really the struggle that right now ranchers are going through. And ultimately, that's what's driving up prices when you think about weather implications, when you think about the lack of inventory inventory and really the need to rebuild this flock, or essentially this supply of cattle. And so that's really has been a stubborn point. We've heard this throughout the past months when it comes to beef and veal, but food at home at large was up about 2.7%. And in the last month, that was up about 0.3%. So clearly, we are still seeing this inflation around those grocery costs. Also, apparel was up. That's something that had been ticking up slowly, but it's not up tremendously based upon the implications of different executives and sources that I've spoken to. The fear that was really baked in back in April about what exactly this can mean for prices. But of course, something that all Americans are facing is really those rising energy costs as well.
It seems like most of the people we're talking to are saying next week's cut is pretty much a lock here. The question is, what do we do beyond that? And also kind of how you strategize around it.
That's right. Yeah, thanks for having me. And it was really exciting to actually get some data that we could dig into here. And apparently we're not going to be getting much more of it until the government decides to reopen. We'll have to see how that plays out. But in terms of the Fed, obviously the numbers that we got today, a little better than expected, so almost seals the deal for a rate cut. I'm very interested as to whether or not they'll also announce that they're going to stop quantitative tightening. I think that's actually a fairly high likelihood event. And what the big difference of opinion, though, there are still those on the Fed who are concerned about the lingering and protracted effects of tariffs on inflation. Whereas the other camp that's more looking for further rate cuts, they're more focused on the labor side. And so if you kind of think about the balance of risks when we have no data to base decisions on, I don't think anything that happens between now and then and even the December meeting is going to change their minds about where they stand on that issue. So it could be a divided Fed, but the majority rules, and the majority is probably going to be calling for that rate cut, not only in October, but once again in December.
Brian, on the inflation side, and fair feed through from tariffs, we are seeing some areas that are affected by the tariffs, those goods that are tariffed. And then we get this news once again that the administration is calling off talks with Canada. So all of these folks who are saying eventually we're going to see more tariff effect. Do you think that that is the case?
Well, I think we are seeing some of it, as you point out. If you look at like the household furnishings, furniture, the apparel, we even like video equipment, things like that. So you are seeing it in quite a few areas. It's just that for the overall picture of the consumer price index, imported goods is only like 16% of what people actually buy. So I think that maybe can help put it in perspective. The big driver of inflation is really services. And that's the part where it was reassuring to see like the shelter component actually moderating, going from about 0.4% month on month down to about 0.2%. So I think we are going to be seeing tariffs. And honestly, I think tariffs are more of a market problem than it is for an economic problem, mostly because what we're concerned about as investors is profitability. And if you look at, if you can't push price higher because consumers are still feeling the pinch, that affects your revenues, but your costs are going up. And so I think that really tariffs are much more of an issue for the markets than it is for the Fed and the economy.
And let's get to what you think people should be doing in this market, because as I mentioned, it's a risk-on rally again today. Large cap tech is leading. We are seeing some of these more speculative areas of the market, quantum computing stocks, for example, are higher again today. How is that going to play out, given that macro backdrop you're talking about?
Yeah, it is very challenging. If you think about it, it's almost like investors are like if you have a cat and you have a laser pointer and you can keep them entertained for quite a long time and yourself entertained for quite a long time by shining that laser pointer. The cat chases that light. And it seems like that's what some investors are doing, chasing quantum computing and whatever else it looks like maybe the government is going to be taking an equity stake, right? And so that can drive the prices higher. But when I think about sort of the underlying fundamentals, the fundamentals of big tech stocks look very good in terms of the growth, but are the expectations too high? So in one of my notes that I put out, it was about how, I'm a big fan of the idea, look for growth, but don't just buy it at any price. Look for growth at a reasonable price as opposed to growth at just any price. And I do feel like there is that fervor in the market where people are kind of ignoring that, there's got to be a little bit of substance here to what you're buying. For that, I'm finding more of that on the value side of the spectrum than on the growth side. Not to say that, we're avoiding growth. It's just that, value is likely going to have its day in the sun. It hasn't for like the last 15 years, and maybe that will happen sooner rather than later.
And what do you think will be sort of the trigger for that kind of migration?
Sure. Well, I think part of it is if you think about growth right now, a lot of the big cap growth companies, they don't have a lot of debt, right? And so if the Fed does show that they are willing and able to continue to cut, not just once or twice, but actually a sequence of cuts, maybe 4 times, I think that could really benefit some of the value companies that do tend to have more debt. We're seeing it with small cap stocks. Now, granted, in small cap stocks, you have to differentiate between the profitable and the unprofitable, right? The Russell 2000, you've got them all in there. The S&P 600 small cap, those are the profitable ones. And so when it comes to the outperformance of the unprofitable versus the profitable, I would be looking for that to change as the Fed really signals that they are willing to continue to cut to try to prop up growth here. And then people are going to maybe be more confident that some of those value names, smaller cap names, are not going to be facing that policy headwind.
Brian, good to see you. Thanks so much.
Thank you.